Hello students, welcome to AccountWise Academy. This is Lata Venkateshwaran. This is the part 4 video of chapter 3 lesson recording of transactions 1. If you want to look into the important question answers and MCQs of lesson 1, 2 and 3, you can look into our shorts of our channel Accounting Explained at AccountWise Academy. Today we are going to learn about journal entries. Actual accounting uses journal for the first recording. So when you want to record a transaction first, then it starts with the journal. Journal. The another name for journal is book of original entry. It captures each transaction with its source document. Source document are the vouchers which we maintain, linking debits and credits. So from the journal entry, we are going to start the debiting and crediting. From journal to ledger. Once when we have entered the transaction in the journal, from there it will be posted to ledger. See here, once recorded in the journal, transactions are transferred to individual ledger account for better organizations. For example, if the journal entry has machinery and cash account in it, then the machinery account amount will be transferred to machinery account and the cash amount will be transferred to cash account or the cash book. Journal versus ledger. The journal is the first draft. So first you have to prepare the journal, while ledger is the main book with detailed account information. For example, if you want to know the balance of machinery account here on a particular date, you can just pick up the ledger and find out the balance on that particular date very easily. Specialized journals. Due to high volume transactions, think about a small business. Even a small business has 10 to 20 transactions in a day. When we go to a business with high volume, the transactions will also be high volume. Okay, so journals are further divided into specific books like cash book or sales book. Let us know about journal in an elaborate way, because this is where the accountancy or accounting stands. Okay, so journal can also be called as your transaction diary. When you write your diary personally, what do you call it as? You call it as a journal. Similarly, in the business transaction, in the business also, if you are going to write your daily transaction, it is called as journal. As simple as this. The another name for it is book of original entry. This already you know. Chronologically, that is date wise records each business transaction. Okay, journal format. It includes date. Date means when the transaction has happened. Particulars. Debited amount. Left side is debit. After it, then creditor account, new line indented with 2 before it. So if you are going to write debit amount, first date is here XXX. Okay, then debit amount you are going to write here, and you have to write debit. Next, if you are going to write the credit amount, then you have to indent it. Okay, 2. Yep, like this. Next, narration, a brief explanation being you have to start with. Explain for what the transaction has happened, or for what you have recorded this journal entry. Next is ledger folio. It has to be filled later, not now. Page number in the ledger where the account is located. When you are going to transfer or post this journal to the ledger, that time only you know the ledger folio number, that time only it has to be filled. Debit or credit amounts. Values of each account affected. So each account, how much the value is going to be debited or credited should be written correctly. Posting to ledger. After recording in the journal, transactions are transferred to individual ledger accounts for better organization. That's what I told you, no? So machinery account will be transferred to, amount of machinery will be transferred to machinery account, amount of cash will be transferred to cash account, like that. Okay. Simple versus compound entries. This is regarding the journal entries. Simple entries involves only two accounts, debit and credit. As we saw, no? Machinery account debit to cash account. Only two entries we had. Compound entry. records transactions affecting multiple accounts more than two debits and credits. So we had only two accounts in the journal entry which we saw now. What are the accounts we had? Missionary account and cash account. Sometimes it may be necessary for you to do compound entry also. This we will see when we do the sums. Okay. So if we have multiple entries, then it's called as a, or multiple accounts in a single entry, then it is called as a compound entry. Page totals. So each page, that has to be totaled. So you have to write in the page all the journal entries. So each page total, debit side should be totaled separately, because we write debit in a separate column, no? Like this we wrote, right? Debit amount was written here and credit amount was written here. So this page will have some 10 transactions in it. After the page, end of the page when you come, the debit amount should be totaled, credit amount should be totaled, and it will tally automatically because you are taking the same amount there, no? So it will be tallied. And page totals carried forward and brought forward to the next page. So here you will write to balance carried down. And in the next page you will write, if this is the next page, you will write by balance brought forward. Whatever is the amount you will write. Okay. Debit, credit. If the carry down is 10,000 rupees, 10,000 rupees, then in the next page also you will write 10,000, 10,000. Okay. This is the format of journal. In this we have 5 columns: date, particulars, ledger folio, debit amount and the credit amount. This ledger folio number will be filled later when we do posting in the ledger. So let us take an example to write the journal entry. Suppose a transaction is on 1724, machinery bought for cash rupees 10,000. Okay, so the journal entry, before writing the journal entry, we have to analyze the transaction. Machinery, we have bought the machinery. Bought means our asset is going to be increased, what we own. When the asset increases, what will happen? You are going to debit it. Okay, and we have bought it for cash. Cash is also an asset, what we own. When the asset decreases, since we are paying by cash, cash is going to be reduced, asset is going to be reduced. When the asset decreases, it has to be credited, and the amount for both is rupees 10,000. So the journal entry will be like this. First write the date, machinery account debit, ledger folio number will be filled later, we don't know about this, so we will leave it blank, 10,000. Intend and write the credit amount to cash account. Write on the credit side 10,000 rupees. Write the narration now, that is the must. We have to write within the brackets. Machinery bought for cash. Narration is nothing but brief explanation about the transaction, so that anyone who sees the journal entry will be able to understand by seeing the narration what the transaction is. Okay. So this is the format of journal entry, and this is how we are going to write the journal entry now when we see the question and solve it. Okay. Before proceeding to writing journal entries, let us now learn what are the golden rules of accounting. See, under golden rules of accounting, accounts are categorized under 3 categories. They are real accounts, personal accounts and nominal accounts. Under real accounts, what we have to do is debit what comes in and credit what goes out. Okay, now the question arises, what is a real account? A real account is an account that relates to assets and liabilities. Okay, basically it relates to assets and liabilities of a company other than people accounts. It does not consider personal accounts, but it considers only assets and liabilities. These accounts do not close at year end. So assets and liabilities we do not close the account and make it zero at the year end. This is not correct. We carry forward the amount. If the assets value during 2023 or 22 is 1 lakh. Okay. In 23 beginning it will be 1 lakh only. Ending of 22 and beginning of 23 it will be 1 lakh. Okay, so we are not making it zero. That is the main concept of real account. Examples of real accounts are bank account, furniture account, land and buildings, machinery, etc. Now let us see what is personal account. Under personal account, we debit the receiver and credit the giver. The personal account name itself we can understand that it relates to persons. So even the rule also relates to the person. See here, debit the receiver, credit the giver. Who is going to receive, we are going to debit. Who is going to give, we are going to credit. That is very easy. See, all accounts related to persons, whether natural persons like individuals or artificial persons like companies. It not only considers individuals, it also considers companies. Okay, artificial persons like company fall under this category. An example of personal account is debtors, creditors, drawings account, etc. Next, nominal account. Okay, nominal account relates to expenses, losses and income. So we debit the expenses and losses and credit income and gains. A nominal account is a type of account in which all accounting transactions are stored for one financial year. So it will be for one financial year only. For example, if you are going to spend on stationery, so this year we are going to close it, make the stationery account as zero. Okay. So we are not going to carry forward the stationery account expenses which we have spent for this year to the next year. So it pertains to next year. When you are going to find out the profit or loss for that year, we are going to take only that stationery account. Okay, that will make it as zero. The balances are transferred to permanent accounts at the end of financial year. So permanent accounts here is, it will be transferred to P&L account. Okay, balance will be transferred to P&L account to find out the profit or loss of the company. These nominal accounts are usually related to revenues, see incomes and gains, revenues, expenses, gains and losses. Okay, an example of nominal account is salary account, stationery account, printing account, wages account, whatever. Okay, expenses and losses which occurs on a day-to-day basis. These are the golden rules of accounting. This you have to mug up and keep it in your mind. Along with the real account, debit what comes in and credit goes out, what goes out. Personal account, debit the receiver and credit the giver. Nominal account, debit the expenses and losses and credit incomes and gains. Okay, you have to by heart it and keep it in your mind. Now we are going to write journal entries for transactions, that is the day-to-day transactions which arise in a company. Okay, Saroj Mart furnishes the following information. This is the question which I have taken from your textbook. Transactions during the month of April 2017 are as under. 1/4/2017. Business started with cash. When you start a business, the money you brought in is called as the owner who brings the money. That money is called as capital. This we have seen in the last video itself. So the money brought in by the owner is called the capital, and he is bringing in what form? Cash. Okay, so when you bring in cash, what will happen? Your assets will increase. When the assets increases, what you have to do? Debit. Capital. Capital is a liability. So now your liability increases. What you have to do? Credit. Okay. So now we are going to write journal entry in the books of Saroj Mart. Let us see how to write. Okay. So we have to write, first start by writing books of Saroj Mart. In whose books we are writing, we have to first write. Then what you are going to write? You are going to write journal. Now you have to have 5 columns. First column is dedicated for date. Second is for particulars. Next is LF. LF is what? Just now we learnt, no? It is ledger folio. Next, debit amount, credit amount. Okay. So, date. Date is 1st April 2017. So, what you have to debit here? This is the first transaction. Okay. What you have to debit? You have to debit cash. So, cash account debit. Write in the debit column 1,50,000. This ledger folio number will be filled when you are going to transfer this journal to the General ledger account. This we will learn later. Okay. And what has to be credited here? Capital to capital account 1,50,000. And we have to write. See, before proceeding to narration, I'll tell. This has to be indented to the right side. You have to write leave 2-3 characters from the debit side, from the debit entry, and write little bit further to the right, the credit entry to capital account, indented, that is called as indented. This also we have seen. And we have to write narration within brackets. What is the narration? Business started with cash. See the second entry. Goods purchased from Manisha for rupees 36,000. So we are purchasing goods from Manisha. So they have not mentioned they have purchased for cash. They have mentioned what they have purchased from Manisha. So they have bought it on credit. Okay. So when you purchase goods, what will happen? Your purchases will increase. Second entry. Your purchases, stock will entry. The stock you will write as when the stock increases, or when you purchase stock, it is called as purchases for the business. Okay. So purchases is an expense. When it increases, what will happen? You have to debit. Okay. And you have bought it from whom? Manisha. Since you have not paid cash, you are increasing your liability. Liability is increased, or Manisha becomes your creditor. When the liability increases, what you have to do? We have to credit. Okay. Let us see the entry. So the date is also the same, 1/4/2017. Entry is, what you have to debit? Can you tell me? Yes, purchases. Purchases account debit. On the debit side 36,000. Indent and write the credit entry to Manisha account. On the credit side it is 36,000. What is the narration? Within the brackets, goods purchased on credit. Okay, next the third entry. Stationery purchased for cash 2,200. You have purchased what? Stationery. Stationery is an expense. Okay, stationery. When the expenses increases, what you have to do? We have to debit. Okay, you have purchased for cash. So cash is your asset. When the asset decreases, what you have to do? Credit. Okay, so the entry is stationery account, same date, see 1/4/2017, stationery account debit 2,200 to cash account. On the credit side 2,200. Narration is purchase of stationery for cash. You have come to the end of the page. When you come to the end of the page, you have to total the debit amount and credit amount, and you have to write here as total CF. CF means carry forward. Okay. So when you total the debit amount, it is 1,88,200. Credit amount is also 1,88,200. Here we are following double entry system of accounting. For every debit there will be a credit. For every credit there will be a debit. Okay. So always debit side should be equal to the credit side. If it is not tallying, that it means you have made mistake. Okay, you have to rectify the mistake. Now it is tallying, so it is correct. We have made the journal entries in a correct manner. We are bringing the total from the previous page, that is called as total BF. BF is brought forward. So the same total we are taking it here in the next page, 1,88,200, 1,88,200. Let us go to the question. 2/4/2017, open a bank account with SBI for rupees 35,000. So you have opened a bank account with SBI. What happens? Bank account you have opened. So bank account is an asset. It increases. When the asset increases, what you have to do? Debit. With what you have opened? By giving cash. Again, cash is an asset. When the asset decreases, what you have to do? We have to credit it. So the journal entry is, date is 2nd April. Bank account debit 35,000 to cash account 35,000. Open the bank account with SBI. Next entry 2/4/2017, same date. Goods sold for Priya for 16,000. So here cash is not mentioned. It means we have sold on credit. Okay. To whom we have sold? Priya. Priya becomes our debtor. Priya has to pay us cash in the future. So she becomes our debtor. Okay, when the debtor is an asset, when the asset increases, what we have to do? We have to debit. Okay, and so when you have sold goods, what is the income? You are going to get the income. No, that is called as sales. By the way of by sales, we are going to increase our income. Okay, so we have to credit sales. Income is increased. When the income is increased, what you have to do? Credit. Okay. So the entry is April to 2017. Priya account debit. On the debit side it is 16,000. To sales account on the credit side it is 16,000. Goods sold to Priya on credit. Received a check of rupees 16,000 from Priya. Priya has paid us check now for whatever we have sold on 3rd April. She has paid us by check. So check means bank. Bank is going to be increased. Okay. So what you are going to do? You have to first Priya. Priya now has paid us money. So your bank account is increased. Since Priya has paid us money, bank account is an asset. When the asset is increased, what you have to do? Debit. Okay. Priya has paid us money. So when the Priya is a debtor, so here we have seen, see, Priya is a debtor, no? Now the debtor has decreased. When the asset decreases, what you have to do? Credit. So the entry is April 3, bank account debit to Priya account 16,000. Check received from Priya. Okay, next 5/4/17. Sold goods to Nidhi rupees 14,000. Again we have sold on credit to Nidhi. Okay, when you are selling goods, what happens? Nidhi has to pay us money as it's our debtor. Our asset increases. So Nidhi account has to be debited, and sales. Sales is our income. When the income increases, what you have to do? We have to credit. So the entry is Nidhi account debit to sales account 14,000. Sale of goods to Nidhi on credit is the narration. Nidhi pays rupees 40,000 cash. So this is the entry. Already Nidhi has bought us from goods from us. Now she is paying us cash. So cash increases. When the asset increases, what you have to do? We have to debit. Nidhi. Nidhi was our debtor, no? So now the debtor asset is decreased. Since she has paid money, we have to credit. So the entry on 8/4/2017 it is cash account debit 14,000 to Nidhi account 14,000 on the credit side. Cash received from Nidhi is the narration. Next, on 10/4/2017, purchased goods for 20,000 on credit from Ritu. So we have purchased goods from Ritu on credit. Credit means we are going to pay later. So when we are purchasing goods, we have to debit purchases. Purchases as an expense. So when the expense increases, we have to debit. Similarly, when we sell goods, that is sales. Sales has to be credited. Our income will increase and it has to be credited. Purchase goods means purchases has to be debited. Sales, sold goods means sales has to be credited. Okay, that you have to remember clearly. Purchases on credit, no? So on credit means Ritu. Ritu becomes our creditor. Creditor is a liability. So we are liable to pay her, right? So when the liability increases, we have to credit Ritu. So the entry on 10th April is purchases account debit 20,000 to Ritu account 20,000. Purchase of goods on credit. So next entry on 14/4/2017. Okay, insurance paid by check for rupees 6,000. So they have clearly paid, told they have paid by check. This is insurance premium. Okay, premium which we pay every year. So by check means again we are going to pay by bank. So, when insurance premium is paid, what will happen? Your expense increases, so it has to be debited. And now your bank, since you have paid by check, your bank is an asset which decreases. Bank balance decreases no, when you pay something, so it has to be credited. The entry is April 14, 2017. Insurance premium account debit 6,000 to bank account 6,000. Payment of insurance premium by check is the narration. Okay, now I'm going to rub this on 18/4/2017. What you have to done? What is the transaction? Paid rent rupees 2,000. So that is the transaction on 18/4/2017. Since they have not mentioned anything, we assume they have paid rent by cash. Okay. Again, rent is an expense. So rent is an expense. When the expense increases, we have to debit, and cash. Cash is an asset. When the asset decreases, we have to credit. On April 18th, rent account debit 2,000 rupees to cash account 2,000, rent paid. Next entry. What is the next entry? Goods costing rupees 1,500 given as charity. The goods which you have bought, no, that you are going to given as charity, which you are using in the business. So charity is an expense now. So charity account expense increases, it has to be debited. From where you are getting the goods? Goods means the stock which you have. So that is you have got from the purchases, no? So purchases is an expense. From that you are going to take out. So that purchase is going to be reduced. So you have to credit it. Okay. Charity account debit on April 20, charity account debit 1,500 to purchases account 1,500, goods given as charity is the entry. Next, on 24/4/2017, purchased office furniture for 11,200. Office furniture is an asset. Asset is a thing which you are going to use for a very long period. Within 1 year means it becomes your expense. More than 1 year if you are going to use something, it is called as an asset. So furniture is an asset. Asset increases, so it has to be debited, and they have not mentioned anything, so we assume we have bought it for cash. Cash decreases, it has to be credited. So the entry on April 24 is furniture account debit 11,200 to cash 11,200, purchase of office furniture. Next entry 29/4/2017, cash withdrawn for household purposes 5,000. When the owner withdraws money for his money or stock, whatever it is, for his own purposes, it is called as drawings. So drawings. So since he is using for his personal purpose, household purpose, it is called as drawings. So drawings. When he invests money in the business, it is called as capital. When he takes money from the money or stock from the business, it is called as drawings. So this drawings will be deducted from the capital. So when the capital increases, what you will do? You will credit, no? Similarly, it is the opposite of capital. When the drawing increases, this will usually be deducted from the capital account. Okay. So when the drawing increases, it has to be debited since it is opposite of capital. Remember this. Okay. And the previous entry, charity, no, this is also very important. This charity entry, that is very important. Okay. These are all very unique entries, so it is very important. Okay. And drawings has to be debited. We'll come to this entry. And he has withdrawn cash, they have told clearly. So cash is an asset. When the asset decreases, what will happen? You have to credit it. Okay. So the entry on April 29 is drawings account debit. How much is the amount? 5,000 rupees. To cash 5,000. Withdrawal of cash from the business for personal use of the proprietor is the narration. Okay. Next, on 30th April Next transaction, see on 30th April 2017, interest received cash rupees 2200. So we have received interest in the form of cash for rupees 1200. So interest received means it's an income. When the income increases, what you have to do? You have to credit. And cash is an asset. It increases, you have to debit it. So the entry is on 30th April, cash account debit to interest account 1200, interest received. Okay, next entry. Next entry is cash sales of rupees 2300 on 30th April. So cash, when you make sales, your cash increases, no? So asset increases, it has to be debited, and sales is an income. Income increases, it has to be credited. So the entry on April 30 is cash account debit to sales account, sale of goods for cash, 2300. Total the sides you get 3,32,400. Total, grand total 3,32,400 from the first transaction. Okay. On 30/4/2017, the transaction is commission paid rupees 3000 by check. So now we have paid commission by check. Again, check means bank. Commission. Since we have paid, it's an expense. When the expenses increases, what we have to do? We have to debit. We have paid by check. So bank. Bank balance decreases. It's an asset. So it has to be credited. So total carry forward 3,32,400 from the previous page. On April 30, commission account debit 3000 to bank account 3000. Commission paid by check is the narration. Again on 30/4/2017, telephone bill paid by check rupees 2000. Again check, see here. So telephone bill is an expense. So telephone expenses is increased. Expenses is increased. It has to be debited. Again check means bank. Bank is an asset. It is, the balance is going to be decreased since we are paying it. Since the asset is decreased, we have to credit the bank. On April 30, 2017, the journal entry is telephone expenses account debit 2000 on the debit side to cash 2000 on the credit side. Payment of telephone bill is the narration. Last transaction is 30/4/2017, payment of salaries in cash rupees 12,000. Again, salary is an expense, right? So when the expense increases, what we have to do? We have to debit. We have paid in cash now, so cash balance decreases, asset decreases, so we have to credit cash. April 30 entry is salaries account debit 12,000 to cash account 12,000. Payment of salary to the office persons is the narration. So when you total, the grand total is 3,49,400, 3,49,400. Okay, with this we are finishing our today's video on journal entries. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take, or to get more worksheets for problems with solutions, contact us at account.wiseacademy@gmail.com. Thank you for watching.